Welcome back everyone. So today I'm going to be looking into 3 UK-based stocks which I consider to be a poor investment choice. As for my portfolio this week, you can see a return of 5.41%. Now switching over to the pie section, we can see that the majority of the pies, and they are different sectors, they are in the green. Now I've been investing in the likes of finance, healthcare, real estate, and if we head over to finance, something that I wanted to show you is if you scroll down to the bottom, you have this option to share the pie. So should I toggle that on, I then have a link, and if anyone's interested, they can have a look at that link and track my portfolio. So for now I'm going to keep that off, but give a comment below if you think this would be interesting. The link provides you with a breakdown of the pie and the different companies and the weightings that I supply. Now, not only have I been investing in individual pies, but I've also been investing in individual companies. So the main call out here is for Dwent London, I've actually been investing more. Unfortunately, I still cannot add this company to a given pie. But scrolling all the way down to the history section, and we can see that I've added an additional 14 stocks. They were brought at different times, so the price was different as a result. And just to call out on my eToro account, for those unaware, you can follow this portfolio and you'll have access to the same companies that I invest in. Citigroup recently has been on a decline, and looking at the financials, I believe that this company will have a strong future in the long term. And so I added an additional stock to my portfolio. So if you're interested in copying my portfolio, I have links in the description below. I've dedicated a video to this in the past, so I'll add a link on the video now. So I came across this news article from Yahoo Finance, and it specifies 3 companies which all exist on the FTSE 100 currently, and they are the worst performing stocks of 2020. Now I should call out that for short-term investors, there's always the possibility that you can buy some of these stocks and you'll see short-term gains and make money as a result. But I always focus on long-term investments. And so in my view, these stocks could potentially hurt your portfolio. Now do keep in mind that these are just my own opinions. I could be completely incorrect in the future. As with all my videos, you should not treat my opinions as investment advice. So just sit back and enjoy. So the first stock to call out, and this is the worst performing stock, down 65% since the start of this year, and it's International Consolidated Airlines. Now, for those unaware, this company is an Anglo-Spanish multinational airline holding company. They own the likes of British Airways alongside other airlines such as Aer Lingus, just to name a few. Now, IAG has made the decision to cut more flights, and it's affecting British Airways as a result. So this is happening over the next 3 months, and it's forecasted that capacity would be 60% below that of 2019 levels, so a massive drop there. AIG has seen a delayed recovery as a result, and they do not expect business to return to 2019 levels until 2023. Now, BA is looking to get rid of close to 13,000 jobs, and so it's no surprise to any of us that the airline industry has been heavily impacted with a slow return to normal trading levels. We have the likes of Warren Buffett himself, who sold all his US airline stocks after the pandemic, and it goes to show how heavily impacted this business model is. Now, as a price point, we can see the massive drops. This company has continued to decrease to lower values than that compared in March when the pandemic took place. Generally, when you see a company that is on a continuous decline, that's had no bounce back since the pandemic, it shows that there are long-term struggles ahead. Now, for those out there that do think the airline industry will recover, then there are opportunities to buy. For me personally, I will be staying away from the airline industry. It's an industry that I've never been exposed to, given the high competition involved. Now, as a consumer, I love to travel, but as an investor, you have to differentiate between companies that are a sound investment choice compared to companies that you just enjoy purchasing such items. So moving on to the second worst performing stock, they are down 63%, so they're in position number 2 as a result, and the company is Rolls-Royce. And so with dividends suspended and profit levels non-existent, I personally find Rolls-Royce to be another company that could have long-term struggles due to being in the civil aerospace sector. However, there are some hopes for the company given that they also have exposure to the power systems segment, and that is a sector we are most familiar with, given this sector focuses on their engines for their car line. Now, similar to the previous stock, we have a similar pattern here. Several months after the lockdown, we can see that the share price is at such low levels, and this just highlights the investor concern for this company as a whole. Now, given that Rolls-Royce has deals with the airline industry to manufacture their engines, Rolls-Royce has a similar problem given their exposure. But as I mentioned, Rolls-Royce has other sectors that they have access to, and that helps to mitigate some of the long-term problems that other industries face. Now, when you look at the price that this was before in the £700 mark, and now you can purchase this stock in under £200, should you believe in Rolls-Royce, then this is definitely a great opportunity to buy in. The main concern I have is when I look at the following graph. So we have the earnings, which have just been negative. We had 1 year that it was positive, and then we returned back to being negative, and these are not small numbers. We can see that we're minus 2 billion at this point here, and so for the last period that we have access to, we're minus 1.31 billion. So there's concerns here for Rolls-Royce. It's a company that I'm going to be staying away from. And so the third and final stock that I'm going to be looking into, they are down 59% since the beginning of this year, and it is that of ITV. Now, ITV is looking to be downgraded from the FTSE 100. So all it means is that the topmost 100 companies, they are listed so that you have other indexes that can track the performance. But based on their previous performance, it looks as though they're not going to be in the top 100. Now, unlike the other companies that I've mentioned, we have ITV that's back to normal production levels within their studios alongside their advertising improvements. So ITV actually had an increase in demand in terms of viewing minutes, and that's as a result of more people watching TV during the lockdown. Now, of course, we're all familiar with ITV as a TV show, but as a company, they have two main sources of revenue, and this is the production sector and their advertising sector. So during the lockdown period, production was halted, and so it's only expected to see a decrease in profits during this period. Now, in terms of the digital space, there have been investment improvements there. There's been certain decisions made within the company, and even during the pandemic period, decisions were made to try and mitigate the impact should there be COVID outbreaks in the future. Now, some of their decision making within the tech sector for me is a cause for concern. There's something called BritBox. I'm not sure if anyone else has heard of this service, but this is new for me. A lot of money has been spent on this service, and so we are yet to see the impact this has on ITV's bottom line. Now, the advertising sector was badly hit due to the reliance of other companies. If you think about the ads that are run on the site, we have a lot of airlines that like to advertise. And so given that there was less advertisement, as a result, less revenue was made for ITV. Now, overall, out of the three companies I mentioned, ITV is probably the best investment choice out there. I would still argue there's fundamental issues with their business model, but what we have seen is positive profit levels from ITV. It's somewhat small relative to their revenue, but we can see in 2019 just under $500,000 in earnings. That's more than we can see for the other companies out there which have not been profitable. That's always important to consider, especially with companies that have been running for a long period. They should really be leveling off in terms of their growth stage at that point, and at that stage you want to see profit after profit. Now, do keep in mind that these are three companies that I will not be investing in. The advice I'm giving to myself is to stay away from these companies, but I'm curious as to what you all think. So my question for this week is, do you agree with my analysis? Do you think any of these companies are an absolute steal, and will you be investing in these companies as a result? So let me know your opinions in the comment section below, and I look forward to hearing your opinions. So last week I provided everyone with my email address, and for those that didn't see last week's video, you can now write into me, and so it's jjamesinvestor@gmail.com. Now, I want to thank those that have written in. Something that I didn't call out last week, that I'm going to keep the names anonymous unless the individual specifies within the actual email. As I didn't call that out last week, I'm going to keep these names anonymous as a result. Now, whether it's your YouTube channel, Twitter feed, any type of handle, if you provide that name, I will provide a shout out in the comment. And so I have the question on the screen right now, and it states, I really appreciate the videos that you make each week. I'm curious why you do not have any bonds within your pie. Do you plan on owning some anytime soon? Now, this is a really nice question. Prior to receiving that comment, I already added this ETF. It's an iShares JP Morgan bond, but I didn't invest. It was at £0 at the time. Since that comment, and once I realized I had no investments there, I manually added some funds, so £116 to date. But the underlying question is, why was I hesitant to add to the bond sector? Now, if you look at the interest rate when buying a bond, right now they are at an all-time low. This is a result of how low inflation is currently. So when the economy is in a recession, the rate of inflation is much lower. And so any bonds that you hold, it's just a contract for how much you're going to loan to the government and how much you're going to receive as a result. And so with low inflation levels, the return in money is extremely low. So for me personally, holding bonds is not the right time. Now with the likes of an ETF, I have small exposure. I'm not holding any underlying bonds per se. Generally, you want to hold bonds when inflation is much higher, when the economy is doing well. For those who held bonds prior to the pandemic, they would have been in a position to actually sell out of those positions. Bonds are just part of a diverse portfolio. And so if the standard stock prices from dividend-based or growth-based companies are struggling, then you're not completely exposed to that entire area. And then you have bonds that counteract that, generally speaking. So in the future, I'll definitely add to this. Right now, for the most part, I've always focused on dividend-based companies. For those that focus on growth-based companies, it's a good time to invest in those. As the economy picks up, then I can always focus on adding more bonds to my account, but the time just isn't right at the moment. With that said, I'm still going to be investing with this ETF that you can see on the screen. At the moment, it's 100% allocated, so I probably won't be adding too much in the future in terms of additional funds. So I appreciate the question. If anyone else has other questions, feel free to write in. Now, a news article that I came across this week is in relation to both Morrison and Iceland, and their plan is to hire more people, and it's in the thousands. And so at the moment we have a lot of temporary staff, and they are going to be made as permanent employees. This is as a result of the surge in demand for online deliveries, and it's all fueled by the coronavirus pandemic. Now, you may think to yourself, in the future, everything will go back to normal. People will be shopping for themselves. They won't have this sort of lockdown mindset and order online as a result. But I think there's been a shift in how people like to do their online shopping. And so online deliveries are probably going to continue to be in demand, given how simplistic it is for the consumer. All they have to do is log on to an app, select their schedule time, and wait for the delivery to come. Now, in saying that, for those during the pandemic, obviously experienced terrible waiting times. Sometimes it'll take a couple of weeks before you could select a time slot. But overall, this is a net positive. So we have the likes of Tesco. They are hiring more staff to support internet shopping. And it's the shift from visiting a store to that of online. And so prior to the pandemic, we had 97,000 workers working for Morrisons. They took on an extra 45,000 temporary staff. That is such a high number. If you're close to 100,000 workers and you add an extra 50k or close to, you've literally increased 50% of the workforce. And given that they're going to be keeping this workforce as permanent, this is a massive ramp up. Now, what's even more exciting here, as an investor, you've got the likes of Morrisons, which is partnering with Amazon and Deliveroo, and it's going to allow customers to do a full Morrisons shop using Amazon UK. So we're starting to see this cross blend between different online services. This is just going to drive demand even further. And so as an investor, this is a net benefit. Now, of course, on the back office of Morrisons, to make sure all these online deliveries take place, you still need people collecting the right products. And so there's more demand in-house as well as a result. Now, Iceland operates at a much smaller scale, but their plan is to have more than 3,000 workers. There's been an increase since March, and there'll be more of an increase up until Christmas. And so there'll just be a higher demand for those home deliveries during the period. Now, it's important to know that Iceland has said that the demand shows no sign of slowing down. There is always the concern that in the long term, some of the demand that they experience does settle down, but having more jobs available is a net benefit for the company and for the UK in general. And it's not only Morrisons that are dealing with partnerships, we have Iceland as well, partnering with Uber Eats in London, and they'll be making deliveries from their Hackney store. And then with the likes of Tesco, they mentioned a couple of months ago that they'll be creating over 16,000 jobs. We have Amazon, they've just seen increased demand as well, so 7,000 jobs there as well. And so an additional 7,000 jobs will be created towards the end of this year to meet all the growing demand there. Now, of course, not everything is positive. There's been thousands upon thousands of people that have lost their job in the UK. We have a statistic of more than 300,000 redundancies from June and July, and we're still seeing the impact as a result. And so for those new to my channel, do consider subscribing. I post a new video every week. And so thanks for watching everyone, and with that said, I'll catch you in the next one.